Friends, will now talk about GST regime. Nowadays, GST has become talk of the town. Let us try to understand as to what it is all about and what are its implications on our day-to-day life. You must be aware that there are two types of taxes which are levied, charged and paid to the government. Direct tax and indirect tax. A direct tax is that tax which is levied on the income and wealth of a person and is paid directly to the government. The burden of such tax cannot be shifted. This tax is progressive in nature, that is, it increases with an increase in the income or wealth, and you may say vice versa. This tax is levied according to the paying capacity of the person. That is, this tax is collected more from the rich and less from the poor. But in case of indirect tax, it is charged on a person who consumes the goods and services and is paid indirectly to the government, not directly. The burden of tax can be easily shifted to the another person. This tax is therefore called regressive in nature. That is, when the amount of tax increases, the demand for the goods and services naturally decreases. This tax is levied on every person equally, irrespective of his financial condition. There are many types of the indirect taxes, such as central sales tax, VAT, value added tax, service tax, SIT, that is securities transaction tax, excise tax, custom duty, and the like. Now let us understand as to what the capital GST stand for. In this acronym GST, G stands for goods, S stands for services, T stands for tax. That is goods and services tax. This is a comprehensive tax levy on manufacture, sale and consumption of the goods and services at a national level, under which no distinction is made between goods and services for levying of tax. It will mostly substitute all indirect taxes levied on goods and services by the central and state governments. So the GST is a tax on goods and services under which every person is liable to pay tax on his output and is entitled to get input tax credit, that is ITC credit, on the tax paid on its inputs. That therefore a tax on value addition only, and ultimately the final consumer shall bear the tax. Let us see what is the objective of this GST. One of the main objective of the goods and services tax would be to eliminate the doubly taxation, that the cascading effects of the taxes on production and distribution cost of goods and services, the exclusion of a cascading effect, that is tax on tax, till the levels of the final consumers will significantly improve the competitiveness of original goods and services in market, which leads to beneficial impact of the GDP growth of the country. Introduction of GST to replace the existing multiple tax structures of central and state taxes is not only desirable but is also imperative. The integration of various taxes into a GST system would make it possible to give full credit for inputs taxes so collected. GST being a destination based consumption tax based on VAT principle. France was the first country to introduce GST in 1954 worldwide. Almost 150 countries have introduced GST in one or the other form since now. Most of the countries have a unified GST system, but Brazil and Canada follow a dual system, which India is going to introduce. In China, GST applies only to goods and the provision of repairs, replacement and processing services. GST rates of some of the countries range between 10% to 15%. This would be two-rate structure in our country, a lower rate for necessary items and items of basic importance and a standard rate for goods in general. There is also a special rate for precious metals and a list of exempted items. For goods in general, government is considering pegging the rate of GST from 20% to 23%. That is well above the global average rate of 16.4% for similar taxes. However, below the revenue neutral rate of 20%. What is the model of GST? The GST shall have two components, one levied by the central, referred to as the central GST or CGST, and the other levied by the state, referred to as the GST or state GST or ST. Rates for central GST and state GST would be approved appropriately, reflecting revenue considerations and acceptability. The GST and the SGST are applicable to all transactions of goods and services made for a consideration except the exempted goods and services. Cross utilization of ITC, both in case of inputs and capital goods between the CGST and SGST, would not be permitted except in the case of interstate supply of goods and services, that is IGST. The center and the states would have concurrent jurisdiction for the entire value chain and for all taxpayers on the basis of thresholds for goods and services prescribed for the state and the center. Let us now imagine that a manufacturing certs sells the same after manufacture at a rate of rupees 110, in which rupees 100 is his input on materials on like cloth, thread, button, tailoring, etc., and rupees 10 is his income. With these raw materials, he manufactures a shirt. In the process of creating the shirt, the manufacturer adds value to the materials he started out with. Let us take the value added by him is rupees 30. The gross value of his goods would then be rupees 100 plus rupees 30, that is 130. At a tax rate of 10%, the tax on output, this shirt will be 13 rupees. But under GST, he can set off this tax of rupees 13 against the tax he has already paid on raw material input, that is rupees 10. GST is abbreviation for goods and services tax, but in my opinion, this abbreviation should be G and ST, which will perfectly explain this acronym. But anyway, GST is used throughout the world, so it is okay for me also. This GST is in fact a value-added tax only. The VAT, value-added tax, is consumption-based tax, wherein the basic principle is to tax the value addition at each business stage. To achieve this, tax paid on purchases is allowed as a set-off, credit against liability on output or income. GST is levied on all transactions of goods and services. Thus, in principle, GST should be differentiated between goods and services. For example, imagine a manufacturer of trouser. He buys raw material or inputs, that is clothes, thread, button, tailoring equipment worth rupees 100 some, and that includes a tax of rupees 10. With these raw materials, he manufactures a trouser. In the process of creating the trouser, the manufacturer also adds value to the material he started out with. Let us take this value added by him is rupees 30. The gross value of this good will then be 130 as it was in the case of the other item we have discussed above. Now, at a tax rate of 10%, the tax on output result will then be rupees 13, but under GST, he can set off this tax of rupees 13 against the tax he had already paid on raw material, that is inputs of rupees 10. Therefore, the effective GST incidence on the manufacturer is only rupees 3, that is 13 minus 10. Now, the manufacturer sells this produce to wholesaler. In this stage, the manufacturer to the wholesaler, the wholesaler purchases it for rupees 130 and adds on value, which is basically his margin of say rupees 20. The gross value of the goods he sells would then be rupees 130 plus 20 minus or total of rupees 150. Add 10% tax on this amount, it will come to rupees 15. But again, under GST, he can set off the tax on his output, that is rupees 15, against the tax on his purchased goods from the manufacturer, that is rupees 13. Thus, the effective GST incidence on the wholesaler is only rupees 2, because 15 already paid, 13 he pays only 2. He has the effective effect of tax is only rupees 2. Now we reach the stage third. The wholesaler sells his purchases to retailers. The retailer buys the trouser from the wholesaler at the price of rupees 150 and adds his margin, say of rupees 10. The gross value of what he sells therefore goes up to 150 plus 10, that is 160. The tax on this amount at the rate of 10% will be rupees 16. But by setting off this tax, that is rupees 16 against the tax on his purchase from the wholesaler, rupees 15, the retailer brings down the effective GST incidence on himself to rupees 1 only, 16 minus 15. Thus, the total GST on the entire value chain from the raw material, that is input suppliers who can claim no tax credit since they haven't purchased anything themselves through the manufacturer, wholesaler and retailer, is rupees 10 plus 3 plus 2 plus 1 or rupees 16. So while the